That is the whole intention of getting that information. And the tribunal may, on application made by the company, allow further time. This has been just notified this month. And the penalties for failure to file all this is severe. If you can see, if you have forgotten to file that form, the penalties are still quite severe, and the penalty provision was not notified in April but has just been notified on 6th June 2014. Okay. So we tell sometimes people, even if you are filing something wrong, at least go and file the form. You can at least get away by saying that, oh, you did not have the right information because your accounts were under audit or something, but at least go and file the form. Your intentions are very clear. Section 75, this is not yet notified. But these are all damages for fraud which are there, and these are again quite severe. If you have accepted deposits, anyone can go and file a complaint against you. So this is not yet notified, but it soon will get notified in course of time. But the damages, anyone can go and file a complaint. It could be a depositor, it could be a group of persons, it could be an AOP who has incurred a loss as a result of failure of a company to repay the deposit. And you may find people that they have changed their address, the check for the refund has gone to the old address, and they go and file a complaint that my money has not been received. It may not stand in any justification in the tribunal, but at least the company will start facing that harassment. That, oh, I got a complaint, now let me go and prove that I posted it to the registered address, he changed his address, it is not my fault. So all those formalities will have to be started, even by a small company as such. And if you are able to prove that there was some intention to defraud the depositors, you had this scheme in the east of India where you had people taking deposits and running away. Even in Bombay you have regular intervals, people coming with deposit schemes and then running away. So if the intention is to defraud, then the liabilities are practically limitless. So it could be anything which can be done by the government in such a case. Acceptance of deposits from public by certain companies. Now here there are very clear rules which are laid down that if you are a public company, private companies cannot fall in this. Public companies can accept deposits above a particular turnover or net worth or something, and there are rules given as to how you can raise these particular deposits. And no company shall accept or renew a deposit less than 6 months or more than 36 months, so no long-term deposits possible. And these are only again public deposits, public companies which can make this. The exceptions are they will not exceed 10% of the aggregate paid up capital and free reserves, and are repayable not earlier than 3 months. They can be joint, several, and so on. All these things will come in your application form as such. If your deposits are exceeding 25% of aggregate paid up capital and free reserves, you cannot accept it. So the limit is 25% of your aggregate paid up capital plus free reserves. For government companies it is 35%. The rate of interest not exceeding the maximum rate of interest as prescribed by RBI for acceptance of deposits. RBI normally doesn't allow more than 2 or 3 percentage points more than the bank rate. The bank rate today I think is 9.25. So they may not allow anything more than 200 or 300 basis points than that bank rate which is there. Deposit insurance, something which even a private company has to do now if it accepts from shareholders also. You need a deposit insurance. The first thing which companies complained was there is no insurance company in India which gives a deposit insurance scheme. And that is why the government gave an extension of that particular provision right up to March 15. They said that till March 15 you may not take insurance. At that time obviously insurance companies will come up with such policies, and obviously that's a cost to the company as such. And it is, I think, estimated by the financial sector that these new rules which are there will increase the borrowing cost from deposits by at least 2 to 3%. All these formalities, all these extra people you will keep, all this insurance is there, that will increase your compliance cost by 2-3%. So if you are actually able to borrow from deposits at say 11%, your actual cost will be 13 or 14% also. So you will have to factor in all that when you now decide to take public deposits. You have to keep these liquid assets and create the deposit repayment reserve account. So which means that on or before 30th April each year, you have to keep 15% of your deposits into liquid assets. Now that 2-3% extra cost includes this idle money also, the cost of this idle money also which you keep, and it will never fall at any point of time below 15% in the whole year. So it's not just that 15% at one point of time, which is what people used to do earlier. Now this is almost at every point of time you have to keep that 15%. If you forget to pay a deposit or there is something wrong, penal rate of interest of 18% has to be paid. Punishment, including, the company and the directors are also there, but the officers of the company who is in default are also punishable of fine, which is a continuing one. So it can be 5,000 per day or something, because it's a continuing fine which is there as such. Okay. So these are the rules on deposits. It badly hits private limited companies. A lot of people say, what is the way out? The way out is obviously first try and fit into this particular exemption limit which is there. Even by converting to a public company, it is not going to solve the problem, because the public company can accept deposits with a very high threshold. You cannot just do it. So a simple way out, a lot of people are saying is, let me convert my company to a LLP, or let me convert that deposit to share capital, or convert it to redeemable preference shares. Now these are some things which people have started doing, converting to LLP, converting to say equity capital, but which is a permanent capital, or to convert it to redeemable preference shares so that I can redeem it after 2 years, 3 years, something, redeemable at the option of the shareholder within 5 years, so you can repay whenever you have liquidity. Interest and dividend, obviously you have to match the tax implications which are there, the deductibility and so on. But different companies are going to adopt different ways in which to tackle this particular problem. But if you have a company which has, for example, I gave 1 lakh capital, borrowed 500 crores and given loans of 500 crores, I think that company may need to wind up. So you may not be able to sustain such companies and comply with everything within a 12-month period as such. So those are the companies they are actually targeting, that they will close down their businesses, and we will really go after these companies which are there. Let's go to the next topic on loans and investments. 185 and 186, only 2 sections, but these 2 sections have created a lot of havoc and discussion so far. 185 corresponds to that old 295, already operational from 12th September, which is where all the problems started, and this is where people sometimes came to know that, oh, the new act has already started. So everyone started discussing 185. Section applies to any loan given directly or indirectly to any director or to any person in whom director is interested, or give a guarantee or provide any security in connection with any loan. So it's a very broad section. Now a lot of people say the section starts with notwithstanding anything contained in any other section. Even 295 started that. So when you read the section, it says notwithstanding, you read the whole section, that also started that way. So if 186 gives you something which is 60%, 100%, that was also there in the earlier section, 295. So you cannot say that because it says notwithstanding, 185 doesn't apply. Now that's the interpretation which has been not accepted by almost everyone. Now the problem which comes is with this any person in whom director is interested, because that is where the crux of the whole section is, that what is the meaning of this any person in whom director is interested. And they have defined it to mean something like this: any person in whom director is interested means any director of a company, holding company, or any partner or a relative of any such director. So you cannot give a loan to any such person, any firm in which such director or relative is a partner, any private company of which such director is a director or a member, any company in which not less than 25% of the total voting power is exercised or controlled by any of such directors. If the board or the managing director is accustomed to act with the directions or instructions of the board or of any directors of the lending company. This is a very broad list. You practically cannot give to any of the individuals, any partnership firms where your directors are interested, or any holding company or in any other companies where your directors are interested, almost directly or indirectly. A lot of people say that this does not cover subsidiary companies. Now subsidiary companies to our view will get covered in the last thing. Because if you have a subsidiary company, your board obviously has a control over that subsidiary. You cannot say the subsidiary is acting independently. That would be too vague a statement to really make. Because if you are saying that the company is my subsidiary, it means you have more than 50% control in that company. And then you say that they are not acting according to my instructions, that doesn't really hold good as such. So subsidiary also will get covered in this. And what is this meaning of relative? Relative definition is also very wide. If you see, it covers, relative is defined like this. We will also see this definition in RPT, but in here also you need to refer to this. It means members of an HUF, husband or wife, one person related to another person as prescribed, and the prescribed persons are only 8 persons now. Earlier they had 15 persons in the draft rules. Now they have brought it down to 8 persons: father, mother, son, son's wife, daughter, daughter's husband, brother and sister. Now this is fine. The only problem is members of HUF. Because that, what is member of HUF? You can have your great grandfather's HUF where there are 100 people. You are all still members of that HUF. It doesn't say member of that director's HUF. So you can be member of any HUF. So it could be your great grandfather's HUF, which can have 100 people, and if any one of them is covered, then you are hit by that restriction of not giving a loan to that particular person as such. And we see that this affects quite badly, in fact, when you come to related party transactions. So anyone, you are a partner or a relative anywhere, you cannot give a loan in terms of this 185. Exemption is available in section 185 for loans given to a managing director or a whole-time director if it is part of service conditions or pursuant to any scheme by a special resolution. And the company giving loans or guarantees in ordinary course of business are also exempt. What is ordinary course of business? Not yet defined, but if you are giving a loan or a guarantee in the ordinary course of business, that is exempt. However, you have to charge a rate of interest which should not be less than the bank rate declared by RBI. If you do not comply with this, penalty is 5 to 25 lakhs, minimum 5 lakhs up to 25 lakhs, and imprisonment of minimum 6 months. Now what is the problem in this section? If you see the old section and this section, private limited companies are removed from the exemption. We see there is some exemption brought in, but otherwise the exemption has been removed. Exemption for loan given to a subsidiary company has been as such removed from the section. The rules are giving some relaxation. We see what that relaxation is. And the major problem is the section does not have any remedial proviso. It doesn't say that if you are exceeding all this, you can still approach the central government and get it rectified. It doesn't say subject to the approval of central government, you can still do these things. So if you have not complied with something, it is state penalty. There is no remedy to this. Even if you go to the ROC and say, oh, I have defaulted in this section, he will not be able to help you. He will say, oh, please come, I will issue a notice for penalty. That is all he will be able to do. He cannot do anything else in this because there is no remedy available in this particular section. Earlier you had remedies like, okay, you pass a special resolution, you get approval of central government. Now, prior approval of central government, sometimes if you go late, they have the power to ratify the loan given or something. But there is no such provision in this section 185 which is there as such. For private limited companies, this draft notification has said that 185 will not apply to private limited companies, again with conditions. What are the conditions? Which have borrowings from banks or financial institutions or other bodies corporate not more than twice their paid up share capital or 50 crores whichever is lower, and in whose share capital no other body corporate has invested money. So if your list of shareholders has a company, you don't get this exemption. So that same example which I gave you, 1 lakh capital, 1 share allotted to a private limited company, borrowed 500 crores and gave out loan to others. That is out of this. Because you cannot have a single shareholder which is a body corporate to avail this exemption. Okay. So this is again a restrictive or a conditional exemption, and I think if people are expecting that this will still be relaxed, that is too far-fetched the thinking. This is the maximum relaxation I think you can expect, because they are obviously asking for comments on this draft notification till 1st July, but you will have to really point out difficulties. And the difficulties cannot be that, oh, I have got a company where 500 crores are borrowed and I don't have time. At the most they will say, okay, we give you time till 31st March to unwind all these things. They may not further relax this conditions which are there. And The final rules also gave a relaxation that if you are giving a loan to a loan given by a holding company to a wholly owned subsidiary, it is exempt. But now you see this is a wholly owned subsidiary. If a single share is also given to someone else, this exemption does not apply to you. And any guarantee or security given by a holding company in respect of loan made by any bank or institution to its subsidiary is again exempt. So either a loan or a guarantee to a wholly owned subsidiary is exempt, provided the loans are utilized by the subsidiary company for its principal business activity. So you'll have to see what the subsidiary is going to use that money for. So if the subsidiary is into say manufacturing particular items and you give it a loan of 100 crores, the holding company is exempt provided the subsidiary uses that 100 crores for its activities. It cannot then go and invest that 100 crores in just shares. So then it is not carrying out its principal business activity as such. So again a conditional relaxation which is given for a loan given by a holding company to its wholly owned subsidiary. Now what would be the status of loans existing as on 12th September 2013? Obviously this is a big question mark for a lot of people. And what would be the status of loans given after 12th September 2013? This is obviously a big question which a lot of people are debating. A lot of lawyers have been working on giving opinions on this. I believe a lot of lawyers have made a lot of money giving opinions on this. What about 12th September 2013? Now if you look at the Act came into force or this section came into force on 12th September 2013. Lot of companies already had existing loans which were given which violated this 185. Loans say by private companies, loans given to other companies which are not wholly owned subsidiaries or something. Now obviously the view which we hold is that if a loan is given before 12th September, the restrictions of this section don't apply. Because you cannot anticipate that the law will come and you take care of it. So any loan given before 12th September, obviously the restrictions don't apply till that loan is repaid or renewed. So you will have to come to ending date for that loan. So if you have given a loan to a sister concern, to an associate concern, you will have to come to ending date for that loan and get into an agreement with that company that okay, the agreement is that you will repay this loan say within 3 years. So till 3 years you have no problem then because it's a loan given before that date with the condition that you will repay it within 3 years. Lot of people came and said that okay, can I give a condition that it will be repaid as and when possible? I think that is too far-fetched. You have to give an ending date which is a reasonable date to be able to comply with the section as such. What happens to loans given after 12th September? Lot of people were not even aware of this section because at this time everyone was finalizing the tax audits for 12th. No one even read this section when it came on 12th September. So in October suddenly a lot of people realized, oh, we have never advised our client that lot of loans have been given, now what do you do about it? There are 2-3 things which were done in that at that particular point of time. Say for instance you are giving a loan to an associate company, to a group company or something which is beyond this particular provision as such. One thing which lot of people advised is that okay, you get into an enabling resolution before 12th September saying that I am giving authority to the board of directors to give a loan of say up to 10 crores to X, Y, Z and these 5 companies. Your actual loan on 12th September may be only 2 crores, but you are passing an enabling resolution before that date that up to an amount of 10 crores you are able to give loans to so and so companies as such. So at least temporarily you are deprived from this particular restriction which is there. But again you cannot be very adventurous in this. You will have to be reasonable in this. You cannot say that okay, I will give loans up to 100 crores to take care of my next 20 years. Now that is becoming too adventurous and obviously the ROC and all are not going to accept such a thing. In fact, some PSUs made a representation to the MCA when this came in that this is going to badly hit companies including the PSU companies. And the MCA said that we are aware of the problem which will come, but this is a deliberate change which has been made in the section. We are aware of the problem and we want to make this change. So there was no reason they would have gone back on this particular relaxation which is there as such. The other thing what people are being advised is, and that is where these lawyers have come in, they have said understand that only 185 came into force on 12 September, 186 never came into force. So till that time section 372A was operational. So they said then I don't need to look at 185, I can look only at 372A, and if I am within those limits of 372A or the exemptions of 372, I am still out of it. Now that's not clearly a view which at least we would accept personally, but lot of legal such opinions have been given and lot of people have relied on those legal opinions. We believe in the first year the MCA is not going to get after these people because the law was really not enforced fully as such. But we'll have to at least follow one of the two things. At least for safeguard, get a legal opinion, place it on record that oh we acted bona fide, we have got this legal opinion, so that we are not violating, and then try to regularize it as soon as possible as such. But these are two ways in which a lot of people are actually now trying to overcome this restrictions of loans existing and loans which were made after 12th September as such. Section 186, which actually became effective on 1st April 2014, prohibits investments to two or more layers of investment companies. The exception is only if your investment or your first investment is outside India, then here you can make any more layers whatever you want, because then you are not governed by the Indian Act, you are governed by that local jurisdiction's company law as such. So in India you cannot have more than two layers of companies, and if you satisfy the provisions of section 185, there is a limit given for any loan or investment, which is that 60% of share capital, free reserves and securities premium, or 100% of free reserves or securities premium. This is a similar limit of 372A which has been incorporated. Now, till this section was notified, lot of people saying 185 cannot work in isolation, and that is why they were saying that therefore I don't follow 185, I will follow the old section. Having got this section notified, it is very clear that you have to first read 185. Only if you are able to overcome 185, then you go into the limits of 186. You cannot straight jump to the limits of 186. Now that is very clear since both sections are now notified as such. In our view, that was clear even on 12 September, but maybe there was some grey area, that is why these legal opinions came in. But once both sections are notified, this clearly appears that you have to first satisfy 185 and then only go to 186. If you are violating 185, then you cannot say that though I am violating 185, I am still within the limits of 186. There is no problem. That is not something which is an answer which you can give now as such. And this does provide a remedy. If you exceed the limits of the 60% or 100%, you can regularize it by a special resolution. There is a remedy available if you cross these limits. There is no such remedy in 185. There are other provisions that if there is a loan given, the rate of interest cannot be lower than your corresponding yield of 1 or 3 or 5 or 10-year government securities closest to the tenure of the loan, and you cannot give any loan or guarantee if the company is in default of repayment of any deposits before or after. This is again a severe thing. If there is one deposit which you have not paid and it is established it's a default, you cannot apply any limits of 186. Now that's a big restriction. Take the case of a big listed company, somewhere it defaults in giving or repayment of a deposit by a day or something, that's a default and it automatically hits your 186 limits also. So we have several big companies who are in financial difficulties who have given loans to their sister concerns, and if they default in a deposit, then they are also hit by, they are not only hit by the deposit penalties, they will also now get hit by this 186 penalties, because automatically they cannot enforce this 186 also. Exemption, except these layers of companies available to loan by a banking or insurance or a housing finance company if it is in your ordinary course of business, or acquisition made by an NBFC whose principal business is acquisition of securities. So if you are an investment company, by your articles you say that, or by your memorandum you say you are an investment company, then you can acquire securities without worrying about these limits also. So that's a exemption given in 186 itself as such. Penalty again it is high, and again imprisonment which can extend to 2 years. Rules also provide 186 shall not apply the loan guarantee security is provided to a wholly owned subsidiary or a joint venture on an acquisition made by way of subscription or shares or subscription purchase or otherwise. Where loans and investments may exceed the limits specified under 186, the special resolution can be passed within 1 year of the notification of the section. So you have 1 year's time in which you can regularize this extra investments or loans which you have given as such. The 186 is a very sensible section, at least in the view of all of us, but from the government point of view, both sections are sensible. Several changes from 372, which we have already discussed, these layers of companies, these limits were earlier not there. Now we have all these limits which are there. The rate of interest earlier was the bank rate, now they mandate this government security of the equivalent tenor of 1 or 3 or 5 or 10 years. Okay. Can loans be given between fellow subsidiaries? I have got company X. It has 2 subsidiaries, A and B. Obviously, X has to follow 185 and 186. But what about A and B? Can I give a loan from A and B? Or can I say that from X, I give a very big loan to A and then A gives a loan to B? Is that possible? So can I give a loan between fellow subsidiaries? How will the limits then apply? Now, answer to that would be that what I need to charge. The office has hidden answers. Not that there is no answer available. May not be there on your slide, it will be there. There, okay. So if you grant a loan to a fellow subsidiary and from the circumstances can be demonstrated that you are trying to overcome 185 limits, then you will have a problem. Because it really goes by your intentions now. And as I said, the penalties are too harsh and severe for a company to take such calls now. It's better to be safe, at least for the first few years, and see how the law is getting implemented. But the government is very keen to prosecute. They are very keen to say that, okay, let us at least imprison 5 people so that everyone else understands what serious we are or something. So whether you want to be those top 5 people, okay. We go on to that last thing which is there. Related party transactions. Now when you come to RPT, which we generally refer to as related party transactions, we normally we have to follow these 4 steps which are there. You have to identify related parties, what are your related party transactions, what is the approval process to be followed for these transactions, and finally the disclosure requirements. So far we are only following more or less the disclosure requirements. For the AS 18 wants disclosure to be done, section 48 2B wants disclosures to be done. The approval process or something we are not really following so far in the old Companies Act as such. But now we have a stringent process to following all the 4 things. And this has been complicated because we have got now 5 things which you have to look for in related parties. If you are a reasonably sized company, even a private limited company or a small listed company, you have got these 5 things now to look for. You have got AS 18, which everyone knows, I know AS 18. 48 2B of the Income Tax Act, which is payments to related parties. Domestic transfer pricing, which is there. Companies Act 2013, which is a new thing which we now start looking at. And you have this revised clause 49 of the listing agreement. Now the last 2 things is what is creating a lot of complications on related parties. I am not still covering the international transactions. I am just talking of domestic transactions. Because if you have international, you also add on one more list here, international transfer pricing. So there also you do a similar thing. I have not included just that in this particular thing. Now, the definition of relative we saw is a wide definition. We already saw this when we were looking at the loans and advances. Now, one anecdote or one thing which I say is when you say members of a HUF, and I don't know whether I have given this example here in a clear session, when you go and visit come or not come? Okay, so